Hey, it's Ryan from the Option Income Advisor, and this is the trade of the day for August 30th, 2021. So we're back on the dividend stock train today. We are talking about a company called AbbVie. I'm sure you're familiar with it. Big drug manufacturer, great dividend payer. And so as we look at our portfolio, and we always encourage you to have that balance of dividend stocks and growth stocks, especially as you're running, the triple income wheel. I think it makes all the sense in the world to have both types of stocks in your portfolio, right? You've got dividend stocks kind of on the lower end of volatility. You don't get as high of a option premium, but you do have that stability. And then you've got growth stocks on the other end where you get usually nice healthy premiums on the option side with pretty big margins of safety, right? You're always trying to just balance that. And I think having both in your portfolio just again makes a ton of sense, just from a volatility standpoint, within the stocks in your portfolio, and just giving you kind of both sides of the market. So whether or not we keep going higher and the growth stocks are leading, or we have more of a defensive posture and some of the dividend stocks, kind of make more sense for the short term. So we'll kind of see where we're at, but we don't have a crystal ball, so I think having that diversification just helps. And when I look at the market as a whole, just in general, we've talked about this. I think a lot of people are calling for a correction just because valuations are so high on a relative basis, and just we haven't had a correction in a while. We have fears of Fed tapering. And so when you take a look at that, it doesn't hurt to have some defensive stocks in your portfolio, right? To start adding some of these names, again, whether it's outright purchasing of these stocks or selling cash secured puts on them. I personally don't think we're going to have a big sell-off, and I've kind of told you why in the past. I encourage you to go back and kind of look at that video and read those articles. But it's a situation where we don't know, right? And even though I don't think there's a correction coming, it doesn't mean I don't want to add some defensive stocks to my portfolio. So you look at the defensive sectors, you got healthcare, consumer staples, and utilities. The one that I like the most out of those three is healthcare, because I think it has some real tailwinds behind it in general. So I think there's probably some growth there, and just again because of those tailwinds, I think you might have just earning stability and less downside, right? Because if you think about consumer staples, we've had a pull forward of earnings, and these things are trading at high multiples, but there's no growth there. And same thing with utilities. Not that the earnings have been pulled forward there, but people are paying higher multiples for them. So you're kind of at a situation where you're paying up for, yes, stable cash flows, but really no growth again. So I think the nice balance there is having some healthcare stocks in your portfolio. So that's why we're looking at AbbVie today, and so that's a good segue to get into the stock profile here for this business. So the stock's trading right around 120. Our strike zone is 102 to 112. So this one ranks pretty well. Again, just high level. Dividend safety value, all above average. I like seeing, especially if we're focusing on these dividend stocks, seeing these high, numbers for dividend safety. I think, is exactly kind of why we want to add some of these stocks to our portfolio. That said, I'll kind of highlight, some things I'm going to talk about later, but I think this stock, while it has upside, I think it's probably a lot more volatile than even these numbers suggest, or even that people think, right? You look at the mean volatility of 19%. We even have a volatility risk rating of 9, which signifies that it's kind of one of the lower volatility, lower risk types of stocks in our portfolio, and we only have a required minimum margin of safety of 6%, right? So all that kind of points to the stock shouldn't be volatile. But I think if you've invested in these drug manufacturers, in the past, whether it's Merck or Pfizer, Bristol Myers or AbbVie, these stocks do have pretty nasty drawdowns from time to time, right? I mean, they run pipelines and portfolios of drugs, and as these things come in and off patent, and as they hopefully add new drugs to their portfolio, they can stabilize earnings. But for the most part, I mean, there's some volatility potential there with these drug pipelines and portfolios. So something to consider. As you look at a stock like this, again, the pullback indicator here is low at 2 because we are trading pretty much at a 52-week high. We're only 2% off of our 52-week high here. So, this is a good one to look at because I think, you always find stocks every day that you might think, okay, well, this thing's run up so much. Can I sell a put on it? Can I buy it at this price, right? And so that's what we're going to look at today. Where do I think the trajectory of this stock could be, in 3 to 6 months? Where is a potential pullback? What kind of things do we need to consider? I think this company has done a good job of, and let me, that's a good segue into just looking at the chart. Because if we look at the chart, it gives you a really, really good kind of history of the stock, right? And so this company was spun off from Abbott Labs in 2013. Okay, so it's been its own standalone entity for about 8 years. It's considered a dividend aristocrat because Abbott, combined with AbbVie, has paid a dividend for almost 50 years, and so it's a very stable dividend payer. But what happened is that Abbott kind of spun off its research kind of related assets or kind of pipeline drugs versus its kind of non-research assets. And so AbbVie is actually a larger company from a market cap standpoint right now. And the fear early on was that they just spun off this business to throw a bunch of these drugs that were running off patent and just kind of let them kind of run off essentially. But what the company has shown, in the short term or just over the last couple of years is that they're willing and able to continue to grow their pipeline, whether it's through acquisitions or just, again, drugs that they have in their pipeline, continue to take them through trials and get them to market. And that's really the name of the game for these drug manufacturers, right? As long as they can make acquisitions of existing drugs or get some of their new drugs to market faster than the other ones are rolling off, then you're going to see, stable and growing earnings, right? If not, you're going to see some crazy, volatile earnings. And so this is really that was really the big fear kind of in 2018 and 2019. You had some short sellers, really running their mouths about, this company and how, their biggest drug, by the way, it's a huge concentration. It's Humira. And it's a drug that went off patent, started to go off patent in 2016. But according to, some of the research I've done and just kind of what they've published, sales have come down, but I don't think they've fallen off a cliff like everyone has thought, because there hasn't really been a good generic competitor that's coming out or has come out, but they expect one that's kind of in process to really start hitting earnings in like 2023 type time frame. So the goal obviously for them is to get as much through the pipeline and diversification as they can, so that it'll kind of offset this runoff that they know is going to happen. And so they made a big acquisition of Allergan back in 2020. That's the maker of Botox. And so at the time, Humira was about 40% of their revenue, so pretty big concentration. But as of Q2 of 2021, so they reported earnings about a month ago, that concentration is down to about 30% now. So that's the goal, is they're going to continue to try to chip away and diversify their portfolio, and I think they've done a good job of that. But that's kind of why I wanted to highlight, this stock is not going to be immune from big pullbacks in the future. And so as you're thinking about, putting a defensive posture on your portfolio, I think this one makes a lot of sense, just like all the other drug manufacturers, but I think you just need to make sure that you understand the dynamics and kind of how their earnings can kind of ebb and flow. Because you can see just in this chart, we've pulled back over 20% 3 times in the last 3.5 years, right? This one, where it pulled back 50%, I think some of that's behind it. I mean, that was before they made the acquisition of Allergan. So I think that acquisition alone, I think, kind of gave the market and investors a sense that, okay, they're not. This is not just going to be a portfolio that they just let run off, right? They're really trying to put new drugs to market. They're really trying to make acquisitions to stabilize the earnings here and diversify. And so that was a big deal. And so the market really, or the stock really started kind of recovering, but then we had the pandemic. The stock sold off 34%. Again, a big sell-off, but not too crazy compared to what all the other stocks sold off at the time. Recovered, I think had some more questions just about, maybe overpaying for Allergan and things like that. Again, stock sold off 20%. So this should give you a sense for kind of what to expect. And, since then we've had kind of a nice kind of breakout from the range at least, right? And we kind of got back up into this kind of new range where the stock was consolidating, kind of between this like kind of 103 range, kind of like 112. And then, just over the last couple of months, we've been able to kind of break out there. And now this is the real level you want to try to get through, right? So this is about 123. And so we're only a couple dollars away from that. So this is where I'm looking, right? So we've got our, and interestingly enough, our strike zone is roughly this kind of range it just kind of broke out from. So kind of 102, 103 on the low end, and then kind of 112. So those are the areas I'm looking to kind of purchase the stock, as it comes back. I think this 103 level will probably be pretty strong, just given that we saw some good consolidation there. But I'll be looking to see whether or not this stock can break out above 123, or if it gets kind of a failed break and the stock gets some resistance and pulls back. So that's a likely scenario. And so as you're looking to put new money to work, if you're currently in the stock, I would just hold it. I think, again, I don't think the drawdown is going to be crazy, but it wouldn't be surprising if it did pull back 15-20%. If there was some kind of news with the portfolio or any of the drugs and trials and things like that. That's when you see these crazy moves in these stocks. But if we can break above that, and we'll look at valuation here in a minute, I think this stock has room to expand its valuation, even looking out further, expecting some, kind of decline in some of the earnings there. I think it's got room for a little bit of multiple expansion and kind of move higher from here. So I think if it does break out and we get some follow through, I think there could be 30% plus upside, with the stock, but it won't be a straight line. And so what I love about a stock like this is that you like the future trajectory of it. You think there's upside. And if you own it, great, hold it. If you're looking to add to your position, that's where you can complement that with writing cash secured puts, right? And so, you kind of have that hybrid approach. And even if you're looking to start a new position, I would say you could potentially buy, say, a quarter or a third of of the total position you eventually want to be in. Maybe buy a quarter or a third, so that way you've got some exposure. If the stock goes higher, you're already going to start collecting that dividend. But then you use the rest of the capital that you would have maybe put allocated towards that stock and sell puts down below the current price, so that you can get a margin of safety there and maybe pick up some shares lower on a dip. The problem with a stock like this that's low volatility is you're not getting much premium, but I think it's just a prudent thing to do because you can still get 0.5% to 1%, on some of these strike prices. So we'll kind of go through that in a minute. But that's kind of the strategy, that if you're holding it, great. I wouldn't necessarily add if you already own the stock. I wouldn't necessarily add at these levels. I would wait for a little bit of pullback. But if you aren't in the stock at all, you can consider buying, a small piece what you eventually want to put in it, and then go ahead and use the rest of the capital for puts, and we'll kind of go through some of these scenarios here. So I guess touching on just dividend for a minute, this stock's considered a dividend aristocrat. Again, it's paid between AbbVie and Abbott has paid a dividend for over or almost 50 years now. And so since AbbVie went public and spun off for 8 years, it's been a great dividend payer. It's raised its dividend every year for the past 8 years, and actually has had pretty good dividend growth. So it raised its dividend about 10% just earlier this year. So it's kind of 1 year growth is over 10%, but you can see the 5-year compound annual growth rate is almost 20% in the dividend. So it's been a really good dividend payer. There's still a bunch of room to increase, right? The payout ratio is still pretty conservative, around 41%. And it does pay a 4.4% dividend. So, I mean, I think if you look out there at the higher yield type stocks, again, this one does have its volatility, but I think of the stocks trading with a 4% plus yield, I really like the balance here of having some upside, to go with maybe some of that volatility that could be coming. But I really like that 4.4% dividend. So valuation wise, if we're looking at where it's currently, because the reason why it's at a 5, which is roughly average, is because if you look at these current valuations based on basically last year's or 2020's earnings, the company had a dip. This was before Allergan's results were combined, right? They just closed that acquisition at the end of 2020, and so that's really what you're seeing in 2021 here. Is you're seeing the combined entity, and again, it did its job with diversifying its portfolio, right? You've got the Humira concentration coming down significantly, and then you've got just a nice pop in earnings. And so if you look out at 2022 and 2023, and again, remember I said that 2023 is when the real competitor for Humira is going to kind of hit the market. And so they're expecting, more of a decline kind of in those sales. And so if you look at 2022, they're expecting earnings to actually go up a little bit, almost $14 a share, and then actually come back down to about 12, right? So between 2021 and 2023, they're kind of expecting, Wall Street's kind of expecting about flat earnings. I think the problem is you just don't know. It's so hard to I think predict, some of these new drugs that could be hitting, or even the acquisitions that AbbVie might be making, in the next couple of years, to kind of really further diversify and potentially grow. And so if you just look at, and this is where I think valuations can expand, right? So this 32 times was based on this low level of basically roughly $2.50 to $3 of earnings. Now we're at, again, almost $13 of earnings. So if we kind of stay even at that kind of $12 of earnings, even looking out to 2023, I think this one's based on the 2022 roughly $13.50 of earnings. So that looks really attractive, right? But again, you got to assume there's going to be some volatility and potential decline in earnings from there. So you kind of got to look. I would look at this and say, if this company can maintain, and I think based on what it's done just in the last couple of years with the acquisition, the stuff it has in its pipeline, they got a lot of things in clinical 3 trials right now. Being able to maintain that, right? If we're at $12 of earnings, and if you look at, Pfizer's trading around 13 times future earnings. You got Merck trading around 12 times future earnings. So there's even some room to expand there. I mean, I think all of these stocks could trade in that kind of 15 times range, right? So if you look at maybe even just a conservative multiple expansion, assuming we can hang our hat on, a certain level of earnings, say $12 in earnings, you're looking at, if you look at 12, let's say 13 to 15 times. So that's not really a huge expansion, to be honest with you. I mean, I think that would be a reasonable valuation multiple for any of these drug manufacturers. If you look at 13 to 15 times $12, you're looking at $155 to about $180 dollars per share, and that equates to about 30% to 50% of potential upside. And so again, that's the upside potential, right? There's a lot of moving parts that could throw that off, and a lot of things would have to happen again with the portfolio, and we'd have to get a lot more certainty around that. But I think that's a reasonable assumption for where the stock could potentially go. Again, any pullbacks, I think given that backdrop, should be buying opportunities. So if we get, just based on its history of, we've seen just in the last 3.5 years, it's pulled back 20%, 3 different times. If we see any kind of pullback in that 15 to 20% range, again, I think that's a great buying opportunity for this stock. It may not even get there, right? That's why I say if you hold the stock, I'd keep it. If you don't own the stock, maybe buy a small piece and then, put the rest into puts, because with the puts, as we'll see, you can still generate a very nice, kind of annualized income, without having to take the risk of buying the stock up here. You're giving yourself a little bit of margin of safety there. But again, I like the upside prospects of the business. I think what they've done the last couple of years and trying to diversify make a lot of sense. And I think it should give investors some reasonable confidence in what they're doing. And then it gives you a chance to diversify. Add some healthcare exposure to your portfolio. Add a nice dividend. At 4.4%. So let's take a look. I think with these dividend stocks, sometimes it's tough to go, especially when there's no earnings risk. So we're kind of in this kind of no man's land between, earnings and especially with a low volatility stock like this. If you don't have any catalysts, you're not getting a ton of premium in the options, right? And so you'll kind of see what I'm talking about here. So obviously there's no EPS risk. So we have been historically, just the last few weeks, looking at the September options, which have about 3 weeks till expiration. But you can kind of see, there's just not a whole lot of premium here. I mean, even the 115. I mean, all of these are above. They're out of the strike zone, and that's what happens with some of these lower volatility stocks. Sometimes, without some kind of earnings catalyst, it's tough to get, a put in the strike zone on some of these, just because the volatility is so low. I mean, you can see the implied volatility here. It's just very low. I mean, anything in the 20s, it's kind of hard to get that 1% per month that we're looking for. And so, again, even the 115, which is kind of the level I would consider. It's a little bit above, our strike zone, but I think it's still reasonable for this company. You're only getting 0.8%. So I would consider that one, but I think just given there's no EPS risk, I think you can go out a little bit further on this just to get, just a little bit more premium out there. And so I would maybe go out to the October, which is, again, it's 28 days more. So, you're basically adding a month onto there, but it puts us right around 49 days until expiration. And so you can see the 115 is actually giving us over 1%. So same strike price. We're just going out, another month, and that's why I like to compare, some of these. And this, the Option Income Advisor website obviously helps you quickly kind of analyze, which options are the best, as you're looking at a stock. And so I would look at this and say, the September one, only gave us about 0.8%. It's the same margin of safety because it's the same strike price. We just went a little bit further out, and I'm okay taking that extra month of risk for a little bit extra yield. And so really we're getting 1.8% over 49 days. Again, so that equates to about a 1.1% average monthly yield. You got a delta right around 30. That's kind of the high end of what we would consider. But again, with these lower volatility stocks, I will accept a higher delta because in theory, these stocks should not be as volatile as some of these other stocks. And the delta is just higher because we're so close to the strike price. We only have a 3.8% margin of safety on this stock. So there's not really an aggressive play here. This would be our base play, with that 1%. And then if you wanted to be even more conservative, you could go down to the 110, which gives you about that 0.5% average monthly yield. But it does give you 8%. It does put you within the strike zone, and then you got a delta around 17, which again is high for the conservative. But again, it's just that balance of having this lower volatility dividend stock kind of gives you those metrics. So that's the cash secured put I would play with. Again, your cost basis, if you're looking at this, would be, the 115 minus roughly the $2 that you're getting. So your cost basis or break even would be about 113, which again is kind of right there where we were talking, where some of that support could potentially be with this stock. So, if that stock pulls back, a little bit from here, and that's what I was saying, maybe you could take a little bit that you wanted to allocate and buy some stock, at this level. But again, you're not waiting for a huge pullback here. But if it pulls back a couple dollars, right, in the next couple months, you get to buy at 115, and then you can really start, building your position there. And hopefully we get that breakout above 123. And again, I think if we get that breakout, I think we could have, 30 to 50% of upside potentially with this stock. So I like it longer term. I think it's a stock that I think investors are starting to get more comfortable with, just as far as how management is handling the pipeline. And again, it's considered kind of a defensive type stock. It pays a 4.4% dividend. I think that alone will continue to garner interest from investors and could propel the stock higher. So I like it. I think this is a great add to your portfolio. Certainly put it on your master watch list. I think it's one that should always be on that master watch list, and continue to follow the cash secured puts, and obviously utilizing the option income platform to help you kind of pinpoint which ones make the most sense. So that's our trade. Take care.